So I'm always going to look at it because there's new ways of thinking, there's new technologies, there's new information that comes, and we want to be able to adjust and iterate on that.
My name is Matt Reiner, managing partner at Capital Investment Advisors, CEO of Wellness Strategies, an author, podcast host, and also a speaker to the wealth management community. My mission is to help every family in this country have access and be served by a human financial advisor. That we all have to live in the moment and not try to force progress too quickly. Let it happen and commit to a long-term strategy in your life, in your business, and in your investment portfolio.
And now, your host and my dad, Matt Reiner.
Christian Hyldahl, welcome to the Future Proof Advisor podcast, my friend. How are you doing today?
Doing great. Thanks for having me.
Yeah, man, this is going to be great. I'm super excited about it. We already got into some of it before we started recording, which is why I think we always need to be recording, even when we're doing the setup for everything. But I'm really stoked about this, talking everything from curiosity, exploration to leverage and being able to say no to also we may get into some AI and innovation, which I'm really excited about as well on that side. So really looking forward to it. But before we do, I just want to get to know the Christian Hyldahl a little bit more. What did the 13-year-old Christian Hyldahl want to be when he grew up?
The funny thing is, I've always been around the business. I've been on this planet for 55 years, and I've been in the business for 56 because my father was a Merrill Lynch. I started the year I was born when my mom was pregnant with me, and I've always been around advisors. I would say that probably something having to do with finance was what I wanted to do as a 13-year-old, barring the fact I probably wasn't going to be in the NBA and I couldn't hit very well. So the Major League Baseball was probably not in my future. So
I love that. So tell us how kind of the young investor Christian evolved to being kind of the entrepreneur investor for other with Varium Investment Partners.
yeah, so I would probably say that learned in the school of hard knocks. I probably as a 13 or probably more appropriately a 23-year-old in getting into the business for the first time, not knowing anything, thinking I know a lot more than I did. A little bit of a guy with his hair on fire, wanting to, change the world or, do something big. And then, of course, the markets humble you, the economy humbles you, life humbles you, and you start learning things about risk control and making sure that, sometimes the return on capital is not as important as the return of capital. And so when you get into times like this, which, I've been doing this for 32, almost 33 years, you start to recognize that these things are, there's significant times in your career. There's maybe 5 or 10 of them in your entire career. And I've been through 3 really sort of traumatic ones. I don't really count the first 10 years of my career. I think I was putting in my 10,000 hours of learning, got my MBA, got my CFA within that time frame, and then very quickly was put into a position of really directing investments.
You have a unique perspective, both from being an advisor and now serving advisors from the investment side. As we talk here about, being a future-proofed advisor and future-proofing yourself, I'm curious to you, what does that mean? What does being a future-proof advisor mean to you from your seat, which has multiple lenses of seeing advisors, but also being in the seat of advisors as well?
Well, I think first and foremost, you have to have something that differentiates you in your practice. If you start to try to look like everybody else, then you become a commodity. And the only levers you have to pull when you're a commodity is price. And we have a lot of fee compression, if not actual compression, then the pressure of compression. I remember I sort of saw the end of how I was running my RIA, my previous RIA, was when I was doing really well, like 400 over on an annualized basis over a number of years in multiple different strategies. And A was, as a small firm, having trouble raising assets. And B, even the clients that I had that were very happy with my performance said, yeah, but we can get this for 25 basis points cheaper. Can you bring your price down? And it was always, I was like, man, I'm doing really well. And people are still coming at me for price cuts because there are other options out there. And so for me, that was a real wake up call that I couldn't be a commodity and offer a differentiated product if I didn't have the ability to, one, control my pricing, and two, be able to offer what I think is a superior process. We're not a product company, we're a process company. And by virtue of that process, deliver what I think is a better outcome for both advisors and for their clients.
And when you think about from an investment management standpoint, in terms of the future, how do you see investment management, just like the managing a portfolio, fitting into the services that an advisor provides to a client or a family? How do you see that evolving from? I mean, because how I imagine it, from your beginnings was investment management was the selling point. Then investment management, as you mentioned, became a little bit commoditized, and planning was. Now we still do investment management, which is still a very key component and core value. But I'm curious, in your mind, as sitting in the investment management thesis kind of singular role, what do you see that how that evolves or how that plays out within the advisor's repertoire going forward?
It's a very, very good question. And it's something that I have really struggled with in talking to advisors. This is a very unique time in our industry when folks under 40 years old have not been through a really traumatic investment experience. The markets have not really collapsed since the great financial crisis. And a lot of those folks were puppies coming out of undergrad. And again, the 10,000 hours, getting to be really good at your job. Takes 5 to 7 years to really be even capable of starting to do some of the things that we do just on a daily basis now. So for us, it was really, how do we educate advisors that investment management is the most easily measurable thing that they do for their clients, and that the more that they try to sort of dumb it down or make a basic model or pay a lot less for whatever outcomes they get, is going to have some sort of price. Nothing in life is free. Everything has a cost. The freest stuff usually has the highest cost. So what I have seen is the active management community do a really, really wonderful job of putting themselves out of business. And that is 95% probably of the active funds out there are some sort of closeted index. So what we really saw was this really mass migration to indexing, to basic models, to trying to commoditize the investment management piece, and then make it up on the planning side. The planning is very important, but the most measurable thing that we have, and the reason why people are going to pick up the phone in the next, if they already haven't, is they're going to say, my portfolio is down 10%, 20%, 15%. What is going on? And they're going to have to say, well, all right, we're going to either buy the dips here. They've been trained. Most advisors, again, under 40 have not seen a bad market. So they've been trained to buy dips. And that's going to work until it doesn't. And one of these times it's not going to work. And so having what I think what is going to differentiate folks is having a process, doing differentiated things that make the portfolios work harder. My father hired thousands of very successful advisors, and he hired probably hundreds of thousands of not successful advisors. And he said the one differentiator between all of them is that they figured out who they were. They were the guy who managed the money and they figured out how to do that well, or they were the guy who was the relationship guy and went out and now gal. So, it doesn't matter. They were the advisor that went out and got the money and then managed that relationship. You have to somehow tap into an expert network. And that's what really Varium is. It's designed to be an expert network of really talented investment people that essentially replace what is done in most firms internally.
Yeah, it's interesting. I had a few thoughts as you were talking through that. One, your comment about, I think that not going through like a really bad crisis is one of them. Also, the idea of, it kind of sounds like there's this argument being made for active management to come back in versus passive, especially if there is a longer term downtrend, which y'all are projecting. I'm also, and I'm curious, we're kind of jumping around here, but I love it because I think that this is such a good conversation. I'm curious of you sitting in your seat. Does the expertise matter in a world of AI and artificial intelligence that can look back and understand and bring together data more, robustly and quickly than an expert? Um, and the only thing I ask is because, and that's why I'm asking, like, where does the future go? Because I know that y'all say in the next 10 years you want to innovate. So I'm curious on how you can maybe pair those together, because it almost seems, as you were talking, the last thing I was thinking of was it almost feels a little bit reminiscent to what we're experiencing currently with the computer engineering market, right? And job market, right? Computer engineers had a special talent that you had to pay a lot of money to get access to because they had a special skill set that was not replicable without, the knowledge and the time. Now, though, you can code products, people are coding products, but they're not necessarily to the level that they are, but they will get there eventually. And now the responsibilities of engineers is now going not necessarily being the coder, but being the reviewer and the thought leader from that standpoint to help generate better products. I How do you see it working within trading and investment management? Either way, I'm curious on that side.
Yeah. So my opinion is that you better be good at your job, and you better have a higher set of skills than what a computer can have. And probably eventually, I don't want my kids to go into this business, to be completely frank with you. I don't know in 25 years that they're even having a amazing skill set is going to make a huge difference in that systems, computers can search gazillions of past trades, find trends, do things that a human just simply cannot do. I actually worry about that more for planning. I read an article maybe 2 months back, something like 80% of financial planning that is currently done, with human hands is going to be done with AI, just with the snap of a finger. Load in a couple of basic data points, whatever. I think trading is going to be a little bit different. And when I said 95% of active managers did a great job of driving people to indices, there's 5% that are really doing active management. Now, I qualify active management. I did a study, first thing out of business school. So fresh out of Duke, again, hair on fire, wanted to change the world. My first job at Delaware Investments, a pretty decent size mutual fund complex in Philadelphia. They had all these systems and all these great tools, and no one knew how to use them. And so they said, Christian, go figure that out. So I had all these systems, and one of the PMs had asked me, hey, what's the optimal portfolio size? I was like, geez, I don't know. Like, it seems like a lot of funds have 70, 80, 90, 100 names. That must be the right number, right? So we had this, system that I forget what it's called, and we're probably not around anymore, but we were trying to figure out the optimal portfolio size from a contribution to risk. And so below 22, 23, you start getting really idiosyncratic risk. A single security could blow up your entire portfolio. But over like 38 to 40, the marginal contribution to risk for every additional name you add doesn't really add to your portfolio. So if you're actively managing a portfolio, if you have more than 40 names, you're kind of getting an index territory. So in everything we do, none of what we do is proprietary. We use third-party managers. They send us models. We do all the trading, the rebalancing, and the reporting. Row cover call overlay on top of it. We do portfolio protection strategies, all the sort of bells and whistles I've been sort of alluding to, but haven't really discussed. But so when we are doing our manager due diligence, we actually look at performance last. First thing we look at is how are the portfolios constructed? And the simplest thing is, all right, how many names are in the portfolio? If they have 75 names, I'm not interested in putting money with you. You're not an active manager. 35 names, really nice number. 30, I started going, you're starting to get a real concentration risk. So there's a real fine line of active management and passive active management that really can be by the number of names in a portfolio. How much do you believe in those names? And then where I think AI is going to take a long time to get to is you can look back at all the data you want. It doesn't tell you what's going to happen in the future. Past performance is has nothing to do with future performance. And so going to extrapolate the data that you get from the outside, whether it's news reports or research reports or whatever, just looking at the company, knowing the company, studying the industry, you can start to say, all right, well, their margins are going to decrease. Their growth rate is going to slow. Their discount rate is going to go up because they're become a riskier company. All those things play into future value. I'm a big discounted cash flow guy. So we look at, okay, so if all those factors start changing, that's going to have a dramatic impact on what we think the company is worth going forward. When we're doing our managing due diligence, we're looking for process. So you have to be able to define what you do, how you do. And I think there's still an advantage to human experience, human interaction, getting variable data points coming at you and making those decisions about whether or not a company is fairly under or overvalued. So I think that AI is going to have some impact on that, the basic stuff. Technology is going to become and has been, but is going to continue to be a very, very important part of differentiation process. And embracing that technology is absolutely imperative for anybody who's going to try to stay ahead of the curve.
Yeah. Have you, and I think that's a fair analysis option of AI. I think it's interesting. They have the past history, but they also have, some skill sets to do predictive nature as well in training it. Have you guys found a way, or are y'all using any artificial intelligence or AI in your processes of analyzing managers and analyzing companies and helping you do some of that research a little bit more effectively so you can focus on, doing more like analysis and trying to predict modeling, or using it to help you do predictive modeling in the future? I know you mentioned you built a technology to help price it, I think you said a little while ago, but are y'all using any of is there anything happening within your world that's benefiting from the utilization of artificial intelligence?
Yeah, and I would my CIO Jeff, who's a PhD, CFA, CMT's got more credentials than probably anybody should, but he's a really smart guy. Also, like a nuclear engineer, like ran submarine engines for the Navy. Really smart guy. So he's been, he and his we have 2 PhDs on staff who really do our asset allocation. We do a lot more data analytics there. We're very data dependent on our dynamic asset allocation strategies. So we're taking data on a daily basis and sort of reconfiguring things for our tactical approaches where we want to make changes. We're much more active in that than we are in our more buy and hold type models. We do a lot more of AI and data analytics on the asset allocation side. Again, we're relying on third-party managers. What we're really doing for the software, and I built it 30 years ago. I started building it 30 years ago. I still haven't stopped. Like, it has to be refined. It has to be built. We do that more for fair value on our option strategies, but using AI in managing massive amounts of data with Jeff and Bear, the 2 PhDs, that they're really my CIO. Those guys have been programming and have been very good programmers even before AI was sort of, the word of the day. So we have always been a little bit on the forefront of utilizing technology to try to take massive amounts of data and derive as much usable information out of that as possible. And we will probably continue to do that.
I think that's an interesting way of doing it. And, there's, pairing AI doesn't alleviate the need to be still intelligent and smart. It's a tool that can help elevate and accelerate some people in the ways that they do things if they have the intelligence to do it. And it seems that y'all have, this focus on innovation and being different. I mean, it's in your name, what we talked about earlier. meaning to be different and to look at things differently. And one of the things that we talked about was, you have this desire in the next 10 years to be an OCIO, to be an innovator in the OCIO space. And I think that there's a lot of people out there, and I would say that I'm probably one of them, of saying, like, I don't know what the OCIO space looks like in the next 10 years. I don't know, how it all plays out given the speed of advancement of technology and pairing PhDs, and if they can scale that to masses, like, what does that look like? What does it mean to you? What does success look like of being the innovator in the OCIO space?
So Varium does mean we are different in lab. And that originally stemmed from our business model. And our business model is completely different than any other OCIO. We're not really an OCIO. We're more of a turnkey CIO. So we are a combination of T and an OCIO, because what I saw the shortcomings of an OCIO were that there's a lot of theory coming out, implementation's not there. With a TAMP, you have the technology and the tools, which, by the way, advisors are not great at integrating technology for the most part. Younger ones are, older ones are not. That's great in implementing strategy, but it's still difficult to use if you don't know how to use it really well, and it's still very time consuming. So our idea was, hey, let's combine these two in a way. We'll take the theory and the implementation, and we'll offer that as a service. In addition, and this is where we're really different, and this is where the innovation comes in. Our business model allows the advisors that we work with to own and build equity in us as we are successful. Our partnership is successful. And so we are cutting them in on the very nice economics of managing money. But what we're also doing is we're saying, you don't need an internal CIO. You don't need 3 or 4 Bloombergs. You don't need a portfolio management system. You don't need all the people to generate reports and do all research that we're doing. Basically, we're taking the most expensive part of the advisor's cost structure, which is their internal investment management, and we're flipping that on its head. We're from an expense into what could potentially be a very large asset that doubles the value of their firm. Our real innovation is saying, hey, we are capitalists. You're taking a risk in doing anything with your investments. If you do it with us, you have the benefit of, if we're successful and if the partnership works, you have the benefit of actually capitalizing on that.
So where does the value, because if I were to go sell the firm, what happens to you? They don't have it. Wouldn't a buyer take that aspect out of it if someone's buying it that has investment research? Walk me through the doubling of the value of the firm, because I think that that's a really great sales stack point.
Yeah. So before I get to that, yes, we are firearm. Solve the transitory problem, it will never quit. And so when we partner with someone, we say, look, for as long as you want us around, we'll be here. Because we work with multiple advisors and what we do is scalable across multiple firms, we're never going to say, we're doing so great, we want all this money. No, we're eating what we kill. So there's 2 streams that come from the client. The first is the financial advisory fee that's being paid. And then there's whatever the client is paying for whatever product the advisor is putting them into. So let's say that they're paying 75 basis points for an advisory fee, and they're paying 65 basis points for the mutual fund that the advisor puts them in, or the SMA, or the whatever it is. That other 75 basis, so it's 150 to the client. That's all basic. They're like, wow, it's 150 basis points. 75 of that is being given away by the advisor. They give it away to those third-party money managers, and which is in a way a smart thing to do, because they have expertise that the advisor is just not going to be able to have. It's going to be very expensive for them to bring it in, much more than 75 basis points. So from that perspective, it's very good. From the perspective that they're giving that away to some third party, is very bad in my mind. So what we're doing is we're disaggregating those third-party managers from that large fee. We're still paying them a fee, but we're saying, hey, look, all you're doing is sending us your model. Here's 15, 18, whatever basis points for that. You're already doing it. After they've done choking on the fact that they're not getting 75, they're getting 50. They go, well, shoot, it actually is about what our profit margins are. That's good business for us. You're going to $300 million with us. That's really great business for us. So we're taking that 60 basis points, shaving some of it off. We don't charge 75. And then that's really where we're accruing the value. So we're a profitable company that gets a very high multiple because our leverage is so high. My fixed costs are very high, but I have zero variable costs. So whether I manage $100 million, $1 billion, or $10 billion, I already have the systems in place, the people in place, everything that I need to manage that. So once I cover my fixed costs, we're a very profitable firm. We could probably sell for 15, 20 times once we reach our scale. EBITDA, and our EBITDA only goes up with every dollar more that we're managing. So what we're doing is we're saying 50% of our company is going to be owned by our advisor partners. So there's going to be 10 of them. Let's just, for nice round numbers, it might be a little less, maybe a little more. The real weakness of my model is I cannot do this for everybody. I don't want to do this for everybody. I don't want to be a jack of all trades sort of solution. I want to be a very customized solution for a very select group of high performing advisors. So what we're doing is we're saying, all right, we build this to a $10 billion OCIO business that is generating $50 million of EBITDA. Someone's willing to pay, let's just keep it simple, let's say 10 times. That's a $25 million check I'm going to give to that advisor when we sell this company, if we sell this company. It also cash flows really nicely, so there might not be any reason to sell. That cash flow gets paid on a pro rata basis out to the advisors every year. So if we're doing 50 million, they're getting a $2.5 million check that goes right to their cash flow. That increases their resale value. If whoever buys them or if they want to sell wants to get rid of us, that's fine. We'll buy back our shares and go do it for somebody else.
I get it. And I think that makes a lot of sense. And it's super interesting. It is definitely a different way of doing it. And it brings people together to kind of for a singular mission, as well, which I think is brilliant, from that perspective. I want to ask one more question. I'm going to transition towards our last two questions because just to make sure I give people their time and give you your time while you're up in Vermont. I'm wondering on your perspective of it, because the other question I was going to ask before I asked the one about 50% return is, I feel that there is such an opportunity to innovate how financial products are delivered and evolving financial products. ETFs were a big evolution. As you talked about mutual funds, there feels like there's an opportunity to do, yes, I guess you could do SMAs, like how you're doing it, but there seems like there is like an evolution that could be done to where the types of services that you provide could be scaled, you know, to the masses from that standpoint. Do you see there being in the next 3, 5, 10 years? 10 years is hard because of how fast things are moving, but 3, 5 years that there are new financial products that then introduce the concept to make it easier to access this type of strategy and investment thesis and management style over the next years?
I think what's going to happen, and you said SMA, so I love SMAs. We hate products. So I will say that there is going to be a massive movement towards owning individual securities and being able to do things with those, like a covered call strategy or portfolio protection strategies. And you're going to see the number of names that people own significantly diminish. So there's almost like an uncoupling of the productization of what has happened over the last 50 years. Products are coming out, so much so that no one can keep track of all of them. And they've all, like, there's a few that have a ton of money and then a whole bunch that don't have very much. So real liquidity issues. I think you're just going to get rid of all that. And really smart advisors are going to start having individual securities, both equities and bonds. There'll still be products like for alternatives because those are going to be, their prices will come down, their fees will come down, but they will be a bigger part of most people's portfolios in the next 5 to 10 years. But what you're going to see is you're going to see individual securities being owned in brokerage accounts all across the nation, whether it's an IRA or a regular account. And what you're going to be able to do with those is much better tax management. And then you're also going to be able to make the portfolios work harder.
Yeah, that's an interesting projection. I don't necessarily fault that or find fault in it. I mean, I think it's somewhat of an interesting trend, and it happens in a lot of industries and markets where what was sexy goes out of sexiness and comes back to be sexy. And so that is innovation in a sense as well. So, I know we didn't get to some of the mindset stuff and curiosity stuff. We learned about it from this conversation. We didn't get to necessarily the leverage and saying no, but I love this conversation. I think it's really interesting to poke around on AI and innovation in a space that is definitely being talked about a lot more. So I appreciate the candor, man. I can't express my gratitude on that side. Before I let you go, though, let's do a quick lightning round. Quick answers, maybe 1 minute here for both these questions. I'm curious. You work with advisors. Let's take tariffs off the table. I know we're recording this around the tariff time, so let's take tariffs off the table. Outside of tariffs, what is the most common question on your clients' minds these days?
Yeah. What's the market going to do? I mean, it's the same question. It's the age-old question. And while I have an informed opinion, it's an opinion at the end of the day. I think one of two things is going to, this is probably one of the more dangerous times of my career. The market's either going to go down 20% or up 30% in the next 2 years. So, and I honestly don't know. So risk management is extremely important here. Portfolio protection, super important. It's like insurance for your portfolio. You hate to buy it, but it's better to have it than not if something catastrophic happens, because there is going to be a winner here.
Last question, quick answer. What's one book out there you think everybody should read?
The oldie and the goodie, which I'm going to re-listen to, Wealth of Nations. And I think getting back to fundamental value-oriented investing, just, good old-fashioned Graham, written in 1930-something, just go back and start reading about the true value of companies. There's not stats, but it's in the results.
Man, I appreciate your candor, your comments, the conversation, man. And I, the best way for people that want to continue the conversation with you, what's the best way for them to continue following you and reach out?
Yeah. So the easiest way is to go to our website, www.variumip.com, VARIUMIP as in investment partners.com, or reach out to me, CR Hyldahl, HYLAHL at variumip.com.
Awesome. Christian, man, thank you so much.